Today is Tuesday, February 3rd, 2026. Silver is trading at $8,563 bit. Gold sits at $4,999.50. And while the financial media is busy explaining why precious metals just experienced one of the most violent reversals in modern market history, I'm going to show you why the real story has nothing to do with what happened and everything to do with who was buying while everyone else was running for the exits. Because here's what the headlines won't tell you. While retail investors were panic selling at the bottom, institutions moved $4 trillion back into metals in less than 2 days. Silver bounced 20% from its low, gold recovered 11%. And the entities accumulating at $79 weren't the same people who dumped at $120. This wasn't a market correction. This was a wealth transfer. And if you're still trying to figure out whether this was a bottom or just another fake out, you're asking the wrong question. The real question is this. Why did vaults drain another 2.8% in a single day while the paper price was collapsing? Why were dealers in Singapore forming queues to buy physical gold on Monday morning after Friday's bloodbath? And why is China's official government policy now openly stating that gold pricing power equals strong currency while simultaneously buying 10 times more metal than they are reporting to the world? This isn't speculation. This is documented fact. And by the time I walk you through what actually happened between Thursday and today, you're going to understand why the forced liquidation you just witnessed wasn't the end of anything. It was confirmation that the game between paper and physical has entered its final phase. More importantly, you are going to see why the people who bought metal at $79 while everyone else was selling are going to be positioned for what happens next. Because what comes after a $4 trillion reversal in 30 hours isn't stability, it's acceleration. Let's talk about what actually moved during those 72 hours because the price action tells a completely different story than the one being sold to retail. Silver hit $121 on Thursday. By Monday, it had crashed to $72.80. That's a 40% decline in 3 trading sessions. The largest single-day drop since 1980. Gold fell from $5,600 to $4,770. Brutal across the board. But here's what separates normal volatility from engineered liquidation. The entities selling weren't the entities buying. When silver collapsed on Friday, trading volume on SLV, the largest silver-backed exchange-traded fund, hit 41 billion. That's not a misprint. 41 billion, the highest volume of any single traded asset in the entire world that day. Not Apple, not Tesla, not any equity, a silver ETF. And you're supposed to believe that was organic retail selling. That $41 billion in volume happened because mom-and-pop investors decided to dump their positions all at once. No, that's institutional. That's algorithmic. That's the paper market creating forced liquidation through margin calls, stop-loss triggers, and coordinated contract dumps. And while that was happening on screens, and something completely different was unfolding in the physical market. Dealers weren't lowering premiums. They were raising them. Buyers weren't disappearing. They were lining up. In Singapore, retail investors crowded United Overseas Bank on Monday, the only bank in the country offering physical gold to buy the dip, not sell by. Despite prices plummeting, individual buyers were adding to positions because they understood what the paper market was telling them. This wasn't real price discovery. This was a fire sale created by leverage unwinding. And here's the part that should make you sit up. Physical premiums didn't compress during the crash. They spiked. When an asset drops 40% in 3 days, premiums are supposed to collapse. Sellers are supposed to flood the market trying to unload inventory. But that didn't happen. Premiums held. In some cases, they widened, which means the people holding physical silver looked at $72 and thought, this is disconnected from reality. They didn't panic. They accumulated. Now ask yourself, what does it mean when paper crashes 40% and physical buyers treat it as a buying opportunity? It means the control mechanism between paper pricing and physical demand is fracturing. It means the comics quote is becoming less relevant to actual metal transactions. And it means the gap between what silver costs on a screen and what it costs in your hand is widening at an accelerating rate. But let me show you where this gets even more revealing. Because the recovery tells you who was really in control. From the low on Monday to where we are right now, silver has climbed back above $85. That's a recovery of over $12 from the bottom. Gold has surged back above $4,999. The $4 trillion that evaporated, 35% of it has already returned in 30 hours. You don't recover $4 trillion in 30 hours through retail buying. Retail doesn't have that kind of firepower. Retail doesn't move that kind of capital that fast. What you're watching is institutional accumulation, sovereign wealth funds, central banks. The same entities that have the infrastructure to dump contracts and trigger cascades also have the infrastructure to buy at the bottom without moving the market until they are already positioned. And here's how you know it was coordinated. Open interest on the comics barely moved. When silver crashed from 120 to 72, you'd expect massive position liquidation. You'd expect open interest to collapse as contracts got closed out. But it only dropped by 5,000 to 6,000 contracts from 148,000 down to 142,000. Compare that to 2011 during the Reddit-driven squeeze attempt when open interest was north of 250,000 contracts. This wasn't retail getting flushed out. Retail already left. This was leveraged speculators getting margin called while institutions stepped in and absorbed supply at discounted levels. The weak hands got shaken. The strong hands got stronger. And now you're watching the snapback as those positions get repriced in real time. Let me drill into the mechanics of how this actually unfolded because understanding execution reveals intent. The crash started with a catalyst. On Thursday, news broke that President Trump had nominated Kevin Warsh as the next Federal Reserve Chair. Warsh is viewed as hawkish. Markets interpreted that as a signal toward tighter monetary policy. Higher rates, stronger dollar, and historically stronger dollars put pressure on commodities priced in dollars, including metals. But here's what doesn't add up. The magnitude of the move. A Fed chair nomination doesn't justify a 40% collapse in silver. It doesn't justify the largest single-day drop since 1980. What it does justify is a 5% pullback, maybe 10% if sentiment is fragile. But 40%, that only happens when the catalyst is used as cover for something much larger. And that something is forced liquidation. Because in the days leading up to Thursday, silver had been behaving in a way that created vulnerability. It had run from $50 to $121 in a matter of weeks. Leverage had piled into the market. Open interest had climbed and every leverage long position that entered above $90 was sitting on a margin requirement waiting to be triggered. So when Warsh got nominated, the entities with the ability to move the market saw an opportunity. They didn't just sell, they dumped. Thousands of contracts hit the futures market in compressed time windows. Prices broke technical support levels. Algorithms kicked in. Stop losses cascaded. And once the momentum started, it fed on itself. Leveraged longs got margin calls. Brokers liquidated positions. Forced selling created more downward pressure. And by the time it was over, billions of dollars in paper wealth had been vaporized. But here's the genius of it. The entities that triggered the cascade didn't cover at the bottom. They let the price recover, which tells you this wasn't about profit. It wasn't about closing short positions at favorable levels. It was about breaking momentum. It was about resetting sentiment. And it was about making sure that anyone who thought silver was going to run to 150 got destroyed before that narrative could take hold. Now, let's talk about what was happening beneath the surface while this was playing out because the physical market was telling a completely different story. Vaults drained 2.8% in a single day. That's not a small move. That's metal leaving the system at an accelerating rate. And it's happening while the paper price is collapsing. Think about what that means. If the crash were real, if it reflected genuine oversupply or collapsing demand, vaults would be filling up. Sellers would be delivering metal. Inventory would be rising. But the opposite is happening. Inventory is falling, which means the people holding physical silver aren't convinced by the paper price. They're ignoring it. And it's not just vaults. Dealers are running out of product. Bullion Star, a major Singapore-based dealer, is down to 1,000 bar left in pre-sale inventory. 1 bar. That's the size industrial buyers need. And after that bar is gone, they're sold out. So while the comics is saying silver is worth $72, industrial users are scrambling to lock in supply because they know the paper price is temporary and the physical shortage is structural. Now add this to the picture. China just released an official government article by Xi Jinping outlining the country's financial strategy. The title Building a Financial Power, and the top priority listed as task number 1 is achieving a strong currency. How do you achieve a strong currency? According to the article, gain pricing power of gold, become the number 1 producer, consumer, and importer. Possess the world's largest reserves. This isn't a think tank report. This isn't analyst speculation. This is official Chinese government policy published on the central government's website. And the article explicitly states that China is close to completing preparation and that the global gold final battle is about to break out. Now let that sink in. The second largest economy in the world just told you they're positioning for a gold-based currency war. And they're doing it while accumulating 10 times more metal than they're officially reporting. In November, China bought 10 tons of gold. Officially, they reported 0.9 tons. In September, they acquired 15 tons. Officially reported, negligible. They're accumulating in secret while publishing minimal numbers to avoid driving prices higher before they're fully positioned. And when they finally reveal their actual reserves, when they show the world they hold 10 or 20 times more gold than anyone thought, the entire metal's market reprices instantly. Every central bank on the planet will rush to catch up. And the gap between paper pricing and physical reality will become impossible to ignore. But here's where it gets even more interesting. Because while China is accumulating gold in secret, the United States just announced its own critical mineral stockpile. President Trump unveiled a $12 billion program to secure critical metals including silver, $10 billion in funding from the U.S. Export-Import Bank, $1.67 billion in private capital, and the explicit goal is to counter China's dominance in the supply chain. Translation: the U.S. government just admitted that access to physical metal is a national security issue. They're not stockpiling paper contracts. They're stockpiling physical inventory because they know what China knows. Whoever controls the metal controls the pricing, and whoever controls the pricing controls the currency. So now you have two superpowers racing to accumulate physical metal while the paper market creates the illusion of oversupply. Think about the asymmetry of that dynamic. China buying 10 times reported amounts. The US launching a $12 billion stockpile, vaults draining, dealers selling out, and the comics saying silver is worth $85. Does that price reflect reality, or does it reflect what the paper market needs you to believe so institutional buyers can keep accumulating without competition? Now, let me address the risks because there are real headwinds and ignoring them would be dishonest. Japan's 30-year bond yield just hit the highest level since these bonds were created. Japan's debt-to-GDP ratio is 250%, the worst of any major economy. The US is at 120% and Japan holds $1.22 $22 trillion in US Treasury debt, more than any other foreign country. For 3 decades, Japanese investors have been running the carry trade. Borrow in Japan at 0%. Send the money to the US by treasuries paying 4 to 5% pocket the spread. But now Japanese bonds are yielding 3.7%. The spread has collapsed. The free money is over. And when Japanese investors stop buying US debt or worse, start selling, treasury yields spike. When yields spike, everything leveraged against those rates comes under pressure. Stocks, bonds, commodities. That's what triggered the initial metals crash, not fundamentals, not oversupply. Forced liquidation as margin calls spread across the system because the carry trade unwound. The US dollar got dumped at the fastest pace in 2 years. The 10-year Treasury yield approached its highest level since August, and the Treasury Secretary was literally calling Japan, begging them to calm the markets while the Fed stepped in to prop up the yen. This is systemic stress. This is what happens when debt levels become unsustainable and interest rate differentials invert. And it's not going away. Japan's debt crisis is real. The carry trade unwind is real. And the pressure on global liquidity is real. But here's the twist. That pressure is exactly why metals bounced $4 trillion in 30 hours. Because when systemic stress hits, capital doesn't just vanish, it relocates. And where does it go when currencies are being debased? When central banks are trapped between inflation and recession, and when government debt is spiraling out of control, it goes to the only assets without counterparty risk: gold, silver, physical commodities that can't be printed, can't be debased, and can't default. China understands this. That's why they're accumulating in secret. The US government understands this. That's why they're building a stockpile. And institutional buyers understand this. That's why they moved $4 trillion back into metals in 30 hours while retail was panic selling at the bottom. Let me show you what this means for anyone holding physical metal right now. Because the gap between paper and physical isn't just wide, it's accelerating. Shanghai silver futures are trading at $12. The Western spot is at $88. That's a $14 premium, 20% above the comics quote. After a 40% crash and a 20% bounce, the premium compressed slightly, but it's still elevated, which means Chinese buyers are paying 20% more than Western paper pricing. But because they're buying physical delivery, not paper contracts. The price of getting actual metal in China is disconnected from what the futures market says it should cost. Now, think about what happens when that premium keeps widening. When Shanghai hits 110 and the comics is still quoting 90, when industrial users in Asia are paying 30 or 40% premiums while Western investors are still watching the spot price. At some point, the arbitrage becomes too obvious. Buyers stop using the CONX price as a reference. They start negotiating based on regional physical markets. And when that happens, the paper price loses credibility entirely. We're not there yet, but we're closer than we've ever been. Because every crash, like Friday's, teaches physical buyers the same lesson. Ignore the paper, stack the metal. And every recovery, like the one we just saw, proves that the underlying bid never left. The only thing that changed was the number on the screen. The fundamentals, deficit supply, industrial demand, sovereign accumulation, didn't budge. Here's what that means in practical terms. If you're holding physical silver and you watched it drop from 120 to 72, you didn't lose anything unless you sold. The metal in your hand didn't evaporate. Its utility didn't disappear. The only thing that changed was what someone was willing to pay for a derivative contract on a futures exchange. And that number is increasingly divorced from the actual cost of securing supply. But if you were leveraged, if you were trading on margin, if you had stop losses set, if you were trying to time the market, you got liquidated. You got shaken out. You lost. Because the game is designed to destroy traders and reward holders. It's designed to punish anyone trying to outsmart the manipulation and reward anyone who just stacks metal and waits. Friday's crash proved that. $4 trillion evaporated. Leveraged positions got wiped out. Retail panic sold at the bottom. And institutions bought every ounce they could at $79. Well, that's not a coincidence. That's the system working exactly as designed. The weak hands got flushed, the strong hands got stronger, and now the next leg is setting up. Let me walk you through what happens next. Because there are only two possible outcomes, and both of them end the same way. Scenario 1, the paper market reasserts control. Silver gets capped every time it tries to break above 95 or 100. They trigger another cascade. They force another round of liquidation and they keep the price range-bound for another cycle. What does that mean? It means the physical deficit gets worse. Vaults keep draining, premiums keep climbing, industrial users get more desperate, and the eventual breakout becomes even more violent. Because every day that passes with silver and structural deficit is another day of supply destruction. And you can't reverse consumption. Think about the industrial consumption side of this equation. Solar panel manufacturers aren't speculating on silver prices. They're building factories based on 10-year demand projections. Electronics producers aren't traders watching charts. They're securing supply chains for products that won't ship until next quarter. And when those users see a 40% price drop, they don't interpret it as demand is falling. They interpret it as we just got a temporary discount on the most critical input in our supply chain. So they accelerate orders. They lock and forward contracts. They do whatever it takes to guarantee delivery because they know that if the paper market stays disconnected from physical reality much longer, the premiums are going to explode to levels that make current pricing look like a gift. A study published in January projected that global silver demand will surge this decade to 48,000 to 54,000 tons annually by 2030. Supply expected to rise only to 34,000 tons. That means just 62 to 70% of demand will be met through mining. The rest has to come from above-ground inventory. And above-ground inventory is being consumed faster than it's being replaced. The solar sector alone is forecast to consume 10,000 to 14,000 tons per year by 2030. That's up to 41% of global supply going into one industry, and it's not coming back. Solar panels don't get recycled. The silver is gone permanently. So every month that passes with silver in deficit is a month where the available supply shrinks. The paper market can manipulate prices all at once, but it can't change the fact that consumption exceeds production. And deficits don't resolve through suppression. They resolve through price discovery. Real price discovery, not the fake version created by futures market manipulation. Scenario 2, the breakout happens now. Silver retest 100 breaks through and keeps climbing. The paper market tries to dump it again, but this time physical demand absorbs every contract. Premiums spike to levels that can't be ignored. And the comics start struggling to make deliveries because inventory has been drained. What does that mean? It means the endgame accelerates. It means 3-digit silver this year, not next. And it means anyone without physical metal gets priced out permanently. Here's what that looks like in practice. March is approaching. That's a delivery month on the comics. And registered inventory, the metal actually available for delivery, has been depleted. When contract holders stand for delivery and there isn't enough metal to satisfy obligations, one of two things happens. Either the exchange raises margin requirements and changes the rules to discourage delivery, or premiums explode to levels that make it economically impossible for short sellers to source metal at spot prices. We've already seen hints of this dynamic. Physical premiums held during the crash. Dealers raised prices instead of lowering them, and institutional buyers absorbed every dip. Now, imagine what happens when March delivery obligations hit and there aren't enough registered ounces to fulfill contracts. The scramble for physical will overwhelm the paper pricing mechanism entirely. And once that happens, the comics quote becomes irrelevant. The only price that matters is the price you can actually secure metal at. And that price will be determined by physical supply and demand, not by how many paper contracts get dumped in the Asian session. Both scenarios resolve the same way. The only variable is timing. And if you're waiting for clarity, if you're waiting for confirmation, you're going to miss it. Because by the time it's obvious to everyone, the metal will be gone. Let me show you what I mean by looking at what's already happening in regional markets. The disconnect between paper and physical isn't theoretical. It's playing out in real time across different geographies. In Shanghai, silver futures are trading at $12. In the West, spot is at $1.88. That's a $14 spread, 20% premium for Chinese buyers. Because they're not speculating on derivatives. They're securing physical delivery. And the price of getting actual metal into China is determined by local supply and demand, not by what the comic says silver should cost. Now look at Singapore. Retail investors queuing at the only bank offering physical gold, buying the dip despite collapsing prices. Not because they're gambling on a bounce, but because they understand that paper volatility creates opportunities in the physical market. They're not worried about whether gold hits 4,500 or 5,500 next week. They're accumulating real assets while Western investors panic sell based on screen prices. And look at dealer inventory. Bullion Star, a major Singapore dealer, down to one 1,000-ounce bar in pre-sale inventory. 1 bar. That's industrial size. That's what manufacturers need. And after that bar sells, they're out. So, while the COMEX is pricing silver at $85, industrial buyers in Asia are scrambling to secure supply because they know the window is closing. They're not waiting for the perfect entry. They're not trying to time the bottom. They're buying whatever they can get because they know that in 6 months metal might not be available at any price. This is what fracture looks like. Paper saying one thing, physical saying another, and the gap widening with every cycle. Eventually, that gap becomes impossible to maintain. Either the paper price adjusts higher to reflect physical reality, or the physical market decouples entirely, and the comics quote becomes a historical curiosity that nobody uses anymore. And here's the kicker. The entities with the most to lose from that decoupling are the same ones engineering these crashes. The bullion banks, the institutions with massive short positions, the players who've spent decades managing the paper market to keep prices contained. They know what happens if physical breaks free. They lose control. They lose pricing power. And they're left holding worthless paper contracts while everyone else holds metal. That's why they're fighting so hard. That's why they're willing to crash silver 40% in 3 days. Because the alternative, letting physical demand overwhelm paper supply, is existential. It's not just about losing money on short positions. It's about losing the ability to set prices. And once you lose pricing power, you lose everything. So, what does that leave you with? It leaves you with a choice. Are you going to treat Friday's crash as evidence that silver is broken? Or are you going to recognize it for what it was, a forced liquidation that created a buying opportunity while institutions accumulated at discounted levels? Because the data is unambiguous. 4 trillion recovered in 30 hours. Vaults drained 2.8% in 1 day. China buying 10 times reported amounts. Xi Jinping publishing official policy stating gold pricing power equals strong currency. The US government launching a 12 billion metal stockpile. Singapore buyers queuing for physical. Dealers sold out of industrial bars. Premiums elevated despite a 40% crash. All of that happened while the paper price was collapsing. Which means the entities moving real capital, the ones with the ability to shift trillions in 30 hours, are not convinced by the comics quote. They're ignoring it. They're stacking physical and they're positioning for the moment when the gap between paper and reality becomes too wide to maintain. That moment is coming. Maybe it's March when comics delivery obligations hit and registered inventory is depleted. Maybe it's when China reveals their actual reserves and every central bank panics. Maybe it's when industrial users start bidding premiums so high that the spot price becomes irrelevant. I don't know the exact trigger, but I know the direction, and I know that the people who bought at $79 while everyone else was selling are going to be positioned for what happens next. Here's my final point. Stop watching the price. Stop checking every tick. Stop trying to time the bottom or catch the top because the entities controlling the paper market don't care about your chart patterns. They don't care about your technical analysis. They care about control. And they will crash the market 26% in a day if that's what it takes to shake out weak hands and reset sentiment. But they can't change the physical reality. They can't print silver. They can't reverse industrial consumption. And they can't stop sovereign buyers from accumulating, which means every crash is temporary. Every manipulation has a shelf life. And every forced liquidation creates the setup for the next leg higher. Friday's crash wasn't the end of the silver story. It was confirmation that the story is real. The paper market just showed you it's willing to destroy 40% of value in 3 days to maintain the illusion of control. And that should tell you everything you need to know about how desperate they are. They're not scared of silver at $85. They're scared of silver at $150. They're scared of silver at $200. They're scared of the moment when physical premiums explode so high that the comics price becomes a joke. And every crash like this one brings that moment closer. $4 trillion recovered in 30 hours. While retail was selling, institutions were buying. While the paper market was collapsing, vaults were draining. And while the headlines were screaming panic, China was accumulating 10 times reported amounts in preparation for the global gold final battle. The crash was the signal. The question is, did you read it correctly? If this gave you a new perspective, hit subscribe. History has the answers. I'll show you where to look.